We have a new intro. It says something like "real people, real talk, raw information,"
Oh,
and
it's real. I thought it was real.
something like that. So I spent all last night making that, and that means it's the first time we're sort of a grown-up channel, and we have all the birthing pains to to show for it. And we're sitting down with Ed Mats like we do every day, and we're talking fill or kill. And I'm making a fill or kill intro as well, and it's going to be a lot of killing, and I don't know how to do filling really. So that's exciting. And you have a great topic today. So far, we've had really good topics, but I think today is the best topic for it. Basically, how to become a successful trader. Am I right?
Yeah, essentially, it's kind of a natural conclusion to some of the things we've been talking about, how you implement that. And it kind of brings the two things together that I've noticed in my past. And I've noticed, because people will realize I'm kind of interested in reading and finding out about other successful traders, that they tend to move in steps and stages. And that it's funny because the markets also, I'm very strongly of the opinion the markets move in steps and stages. They don't, although they give the impression of moving everything at once, they actually do it step by step by step. And the same thing with trading. To be a successful trader,
Yeah.
you can luck it. You can, your first trade, be a big trade and you can make loads on it and thank you very much. And it's a platform and you carry on doing really well. Unlikely. Or you can do it step by step by step and recognizing that over time, trading is a slow process, methodical process. Over time, you make 2 steps forward, 1 step back, and as you in a year or 2 years, 3 years down the line, you look back and you compare yourself to where you were, and then you realize you've gone a long way. And I've never one thing that strikes me, Sverre, is since I started trading a long time ago, that people are so lucky nowadays to have the information to help them
Yeah.
to learn to trade. Whereas, it was very much back when I started, very much relying on mentors and other people and what they did. And there were very few books about it. You've got the Jesse Livermore's are out there, etc. But there's so much more information now. And that's part of the problem because more information, more opinions, more ideas as to what you should do, it creates more steps. So
Yeah.
the important thing is to recognize which steps to take in which direction.
Can I ask you something in danger of throwing you off?
Yeah, go on.
Do you remember your first trade?
Yeah. I actually talked about one of my first trades, and it wasn't my first trade. I described it as my first trade because it's my first proper trade. My first proper trade, I made 750 pips in dollar mark and took it back break even.
Yeah.
That's the one I talked about the other day,
But that's
which
not.
was
Oh yeah,
everyone's
yeah,
just
you remember.
whoa, how the it was just like I got so many people telling me giving me lessons. I didn't need any lessons. I just saw 700. What was that? That was 4% plus just come back in my face. But so that was a lesson in itself. My first lesson, my first trade. Well, apart from I did a few other little things, shares and stuff like that. My first proper trade in a dealing room was I sold cable. And I sold cable a day before I went on holiday. And I was going on holiday for 2 weeks and I had a stop. And I came back and cable was 8 cents lower. Yeah, thank you very much. Cool. But I'd been stopped out. I stopped out the day after I went on holiday and I stopped out at the top.
But do you think it's okay to have because you mentioned that a number of times, like having trades on when you leave? Are you comfortable doing that? Like
Yeah.
even trusting a stop?
Yes. You got to trust the people you leave it with, but as long as you do trust the people you leave it with. In that instance, it was in a bank and they were looking after my stop. And I guess if they didn't do it, it's down to the bank. Yeah. So I mean, it's all kind of internalized in that instance. Now, obviously, I'm by myself, well, kind of effectively. Then it's different. Yeah. But you still have, it's a question of trust. You have to trust the people you leave orders with. And if you don't, then that's a flag in itself. But it's all about, there's a lot of learning processes, a lot of steps to learning. And I can't, because for me, it's been over quite a long period of time. It's actually quite difficult to mark it out into different phases or steps, because there have been thousands of steps.
Yeah.
And I would be absolutely gobsmacked now if, if I explained to myself back, 20 years ago when I started, what I know now and what I do would just be it would freak me out. I wouldn't recognize the person that I am either. I wouldn't recognize someone who's so rigorous, so methodical, so disciplined in what I do.
Oh, really? That's interesting. So you weren't always like this, because you strike me as quite a person with quite a strict routine and a strict approach and a strict, like, you approach it very methodically. Very little emotion in your trades. But you weren't always like that?
No, of course not. That's something you learn as you go along, I think. Well, not necessarily learn. It's learned for you. You're beaten up to learn it.
Yeah.
I mean, that's kind of like you teaching a dog to, do tricks. It's sometimes you get whacked about or whatever. Not that I would ever hit a dog. I should be careful of that analogy, but but you know what I mean. I'm a dog lover, so I don't quite know why I went there. I just
it's very dark. It's very dark.
I can tell you why, but it doesn't matter. It was a film I was watching with my kids.
Oh no.
But anyway, let's get more on point.
Yeah.
So basically, what I wanted to do was take a twofold approach to becoming a successful trader. One is to recognize how to be successful now. It's kind of back to front, but I want to do it this way, about the markets moving in step. And then I want to talk about how traders should move in steps, or they do move in steps. So I wanted to start with something, just throw something out there, which, well, not throw it out because I've thrown it out there before. Have you got an Aussie gold chart there, the one I've shown previously?
I sure do. I thought we were starting.
Because I kind of wanted to use this as to take it from the concept of fundamentals and correlations. I've said quite clearly gold is correlated to the Aussie, but there is a difference. There's a I can't speak this morning. Where are my teeth? 590-hour difference between the two. Aussie is being led by gold, and it's working tick for tick. And you've got to ask yourself, well, why is that? You don't need to know why necessarily. You just trade it that way. But then, if you know that it's moving in steps, then if you just need to look at what's ahead of you, then you can trade it well. There's another currency, another market that is doing something very similar. It's following the same pattern. And so on the weekend, I produced a video on marketvisiontv.com, boom, boom, plug, on dollar Canada. Dollar Canada is an amazing currency. And it just excites me. I mean, obviously it's excited me more recently because it's been a rampant trend. But there's, do you have that really long-term chart there on dollar Canada?
I really like this. Michelle found this chart, was it?
No, I gave it to Michelle. I showed it to Michelle.
Cool. Yeah, it's very interesting.
Well, it's what is it? It's 156-year chart on Canada. And you can see that pretty stable, fluctuating effectively, I think, around parity, saying there's a long-term equilibrium point of parity. And kind of obvious, isn't it? It has a stable relationship with the US. You can see that the sterling is slightly different. And there's in a video I discussed about the reasons for the fluctuations and one of the reasons why we're getting a fluctuation now. And it's something I alluded to before. It's the same thing. It's lagging the Aussie behind gold, and that it's actually got a correlation to gold. And just as an aside, someone can help me out here, because I was just thinking this through. If let's say we go back to the Aussie, if you say that the Aussie is clearly following gold, then they're correlated. They're very highly correlated, 95%, probably something of that dimension, or something so strong that you can't ignore it. But if you were to put them at the same time, they wouldn't be correlated, and therefore the stats would be saying something like they be like a 60 or 70% correlation, and so that's not really enough to trade on. So the question is how some of these figures we get on correlations, the stuff I get through Reuters, on correlations are matching time and suggesting something's not correlated. Whereas in fact, if you look at the timing difference, they could be highly correlated. And it's my belief that markets are far more correlated than they appear to be because of the time difference. And very few people have seen the link between Canada and gold. You know, traditionally people say Canada, and this is discussed in the video I did on the weekend, Canada is related to obviously dollar index, the S&P traditionally, although that broke 2 years ago, silver, strangely, and more recently gold. But it's the time lag is quite significant and it's moving in steps. So what it's saying is that gold, then Aussie, then Canada is markets moving step by step. And there's one reason why I think this is happening, and it all relates to a theory I've articulated before, is do you want to put up the chickens? There ain't nobody here, but that's chickens.
I was wondering where we're going with this.
Wait, you're wondering where the chickens?
Yeah.
It's the flood of quantitative easing dollars out there that is looking for a home, that fueled the big bull market in gold, and gold did its stuff, and the bubble burst, and now those dollars, went elsewhere. Went elsewhere, in my opinion, into the Nikkei, into selling yen, and they're looking for a home. And what we're seeing is we're seeing those headless chickens, the quantitative easing dollars, finding new homes step by step by step. You could argue Bitcoin was one of them. I don't know, maybe, probably. But those dollars got to find home. Have you got a brick out there? Do you know, I've showed that previously about correlations. Yeah. You know, the chart of how the emerging countries' currencies are moving step by step by step. Don't think I put it there. My apologies, I've thrown you wobbly there.
I have it somewhere, but it's deep down in the archive. Let me find it.
Well, put up the other one about bubbles then. Can you put up the one about bubbles? Yeah. And that's the theory, is that the quantitative easing dollars are creating bubble after bubble after bubble. And
speaking of this chart here, have you seen the one on Bitcoin? I don't have it handy right now, but the one on Bitcoin is especially on Mt. Gox, is so amazing because it actually it overlays the chart on the top left almost perfectly, almost tick by tick. It's incredible.
Well, I tweeted that. Yeah, you know that.
Yeah.
Tulip. Yeah, I called it capitulation because I compared tulip, which is the standard bubble, tulips, the 17th century tulip bubble, with Bitcoin, and it's the same process. And obviously the Nikkei well predated quantitative easing, but same bubble structure.
This is the chart I meant. Is that the one? It's incredible because this is Mt. Gox here. It's almost perfectly overlaying it.
Yeah.
Isn't that amazing?
Yeah.
Of course,
as I said, I
there are some practical
tweeted that in December, but it doesn't matter.
Yeah. No, I know that, but it's fallen down to the bottom again.
So I don't know what to say. Of course, yes, I agree entirely with it because I had the same idea, but it doesn't matter. And gold, oil as well. It followed the same pattern, and now is a punctured market in that sense. The volatility's died, and you can see there are other markets of. Gold followed that and is in a similar position, and South African Rand, and you can see what it's saying about that. Possibly the Dow. Hello, 1928 Dow. Same type of thing. The headless chickens with all those quantitative easing dollars are looking for a home. So it's not surprising the market's moving step by step by step, and it becomes quite difficult, because you would have thought, well, this is all so obvious. It's such a nice theory. I can throw Bitcoin into that. It's all such a nice theory, but why isn't everyone see this theory? Why isn't it so obvious? Because there's a lot of noise out there. You see one market will be influenced by another, and you're often we're too close to it. This is the biggest problem. We're often way too close to see some of these trends and these observations, but they exist. And that's the question of trying to identify and strip them out. And if there's a couple, if you want to put up the thing I referred to before by Martin Evans, isn't it Martin Evans? About how it takes time for the fundamental news to get absorbed into the market. But if you think it takes time for the...
Do you mean, yeah, Martin D.D. Evans, yeah, sorry.
Yeah. If it takes time for people to react to fundamental news or the fundamental news, then if it takes time to get to them in different stages, then they're going to react in different stages. It's no surprise that you see step by step by step. One market, the investment decisions, the criteria, the drivers behind it will be different to other markets. So it's not that surprising that similar correlated markets will do things, very similar things, but in a slightly different time. Now, from a trading perspective, that's brilliant. It really is brilliant, because although we believe we live in a global market and the market moves together with the same influences, it means that, like we did a couple months ago, sterling yen was a week ahead of euro yen. And just look at euro yen chart, thank you very much. And we had some strange things with the DAX. And obviously Aussie gold is doing the same thing. It's a gift. I mean, there's no such thing as a free gift, but it really does make our lives easier. The fact that markets don't all move at once, it means that if we miss one market, we don't necessarily need to go chasing it, because the same conceptual, even the trade setup could work for a similar market doing something similar at another point. And so that's why it's quite important. And here's the one I tweeted on the weekend, Paul Tudor Jones quote about how he believes that prices move first, fundamentals move second.
Yeah,
and so it's making the same point that my view is that the fundamentals are moving, we just can't see them, and that the reason why prices do appear to move first, and then we find out about the fundamental reason, as we talked about previously, we often find about it too late, and that the price is the indication of what's really happening, and they're moving in sync, but step by step by step, which gives us a great opportunity in identifying similar trades, but at different points. And if we miss one, we don't need to chase it, because there'll be a similar market coming around the corner. And on that note, I know people have been asking me about the DAX, the fractal, the Mandelbrot fractal, which is working a dream. Yeah, I mean, it's going tick by tick, and it's got down up to 96.90, which means then, since it's traded the way it has, it basically means it's identical in price as well as structure, and it's kind of very similar in time as well. Basically says for this week, we've got time to chew the cud and talk about some of these theories and concepts, because although it's bullish, it should go sideways for the rest of the week, and it's only on Friday that it should start to break higher out of that bubble. And if it goes to the same price, the same structure, the same time, then we're talking about 98.90 as a blowout to next week, and get everyone bullish and long, stopping out on the shorts and get them long for 10,000 and find that it doesn't quite get there, and it gets handed back to them. Same type of thing that we saw in the beginning of the year, and we've seen the NASDAQ do that already this year. So there's an example of a market doing step by step by step. Maybe one or two other markets will do something similar. And if I've got to throw this one out here, it's very apart from Howard's The Great Last Chance to Sell, I think I'm going to have to keep mentioning Ed Sakota to you and his banjo playing.
Way ahead of you. Do you want the video again? I don't know where to find that.
No, it's fine. His whipsaw song. For all that and all the, I always for some reason bring in Foxy Forex when things don't kind of go together, and great banjo players. I don't know if that's a banjo or not, but a musician like Ed Sakota being a brilliant fund manager, brilliant trader, very successful. And he's featured quite strongly in Market Wizards books and other similar things as well about some of his approaches. He has 5 steps to trading. He calls them his trading rules, and cutting losses, running winners, keeping
keep bet smalls, keep
bet smalls, follow rules without question, but know when to break the rules. They're all very, very solid steps, if you like, to you start to implement them one by one as a trader. It's often
especially
quite
the
difficult.
first 2. There
Sorry?
isn't the first two in practice much harder to do than in real life. I mean, some traders, I don't remember his name, from the Market Wizard books, have incredibly tight stop losses. But
Well, yeah, I talked about there's a picture of Paul Tudor Jones in front of his house saying that he has very strong views, but a very small, what's the word, tolerance for pain in the
yeah,
short term. In other words, he doesn't. I do the same. Yeah, I have. I try to move my stops break even as soon as I possibly can.
yeah,
So I'm not risking anything. And it goes back to my very first trade, my holiday. I've done quite a few holiday trades that have done that. I get stopped out on something that's a great idea, but
yeah.
so
but,
I didn't. I
but
didn't.
you prefer to lose a great trade rather than enduring the pain of maybe the first couple of tick downs, and because psychologically it's a very different place to be.
It's entirely on the circumstances. Ordinarily, my general approach is let it go. You missed it. So what? There's one around the corner,
Yeah.
And there always is.
Yeah.
And people have, I would say one of the things about trading is one of the blocks to trading is the here and now. It must be what's happening in the next 6-8 hours. I need to make money today. No, right now. If the opportunity's there, it's not there. Don't chase it. Don't force it. They will come. The opportunities will definitely come. Probably this week, if not this week, next week, and then the month after that, and the month after that. They do to come, and you find that if they're not coming, then you start to develop things. You don't force it. You develop things for the different type of market you may feel you're in. It's no longer a gold trending market; it's a ranging market, and you realize over a period of 3 months that you're forcing it too much. And there's not here and now trading gold. It hasn't been for a long time, and probably won't still be a here and now trading gold for quite a few months to come. But you change things. You don't ever force it. I mean, one thing we do, we learn, we improve over time. We improve because the great thing about trading is it's not like football, maybe as a midfielder or whatever, and people say you're good and you believe them, whereas in fact you're getting worse. There's quite a clear bottom line in trading that tells you you're not doing well and you are doing well over time, and it's your P&L, and that's the great thing. And it's recognizing that you may improve, you may be improving, but your profit and loss isn't improving yet, but it will down the line. There are several stages of competence, which takes us nicely onto kind of the theme I wanted to get to, because it's important to recognize that there are different stages and steps in becoming a trader, and ultimately if you want to be a fund manager in doing that as well. And there are a lot of steps. Have you got a video to hand on
the steps? Yeah.
On the steps, the stages
of learning,
of competence.
The 4 stages of learning.
Yeah. It's the same. It's the same thing. There are 4 stages of learning, but this what I've picked up on 5 stages for trading. But if you want to run the video, then it's.
So one of the things I wanted to talk about today, because it keeps coming up, and as I was talking with you, and you're moving into this new position, is this the learning stages. And we learn this a lot in leadership development type classes, and it's one of the things that I work with in my leadership program when I work with nonprofits, executive directors. It basically starts with the idea and the concept of unconscious incompetence. Basically, you don't know what you don't know. And it's a blissful, lovely place to be, because you know nothing, and you don't care because you don't know anything. But then there's that moment when you go, oh my gosh, I know nothing. And that is the next stage of learning, which we call conscious incompetence. So you all of a sudden know what you don't know. I call it moving into your 30s, because that's kind of follows the same kind of thing, where all of a sudden you go, oh my gosh, I know nothing. And then through learning and training and knowledge and gathering and mentorship, you move into the 3rd phase of learning, which is conscious competence. And that's the best place to be, because you're still so excited about what you're doing, and you're learning so many new things, and the best teachers come from that, because they can take something and say, hey, I just learned this, here's how I applied it, and here's the information I'm giving to you. And the fourth stage of learning is unconscious competence. These are the people that just, they know it. It's in their bones, it's in their brain. The problem with that is the next stage after that is right back to unconscious incompetence. When you get to that point where you know everything, you're not learning anymore. And when you stop learning and things change, you don't see it. Huh. And so it's one of those, if you've ever seen The Illusion, where you keep walking up the staircase, it's the same kind of thing.
Sorry. Yeah.
I think there's really good. I tweet it. In fact, I have tweeted it before. It's drawn. I found it through something called the Kirk Report, but it's basically written by an anonymous guy. I get the feeling it's someone who was at university as a trader, pretty smart person who's quite self-aware and saw the links between what are known to be the 4 stages of learning and what they believed were 5 stages of becoming a successful trader. And you ask, well, where's the 5th stage? And the 5th stage is what he calls the eureka moment. When you start off, you don't know what you're doing. You may do, the unconscious incompetence. You may be successful. Your first trade may be successful. Your first 10 may be successful. You may actually think that, that's the report. You may actually think that you have found the Holy Grail and that this is easy. And I'm sure we've all been in the position at some point, not necessarily early on, but we thought this is actually quite easy. I can do this, and I can make lots of money, and I don't have to work that hard to do it. And then you go, you suddenly start to lose money, and you realize that in fact, you start to recognize how little you do know, and that's often when people they go out there and they start testing different systems, even the whole different approaches, not necessarily they might start being quantitative analysis rather than qualitative, and there are lots of services out there selling different systems, and it's that type of person, once they realize that they can't succeed themselves without some sort of help or method, they go into new systems, they go into chat rooms, and they think this is the way to go, and it's a really hard, long struggle. And in fact, that's when most people quit. The figure, I don't know what the figures are, but apocryphal figures, about 90% of people quit, burn their accounts within 3 months, and many don't come back because they get to that stage of actually you were in a similar position, were you, when they realized that in fact maybe trading is not for them, it's not so easy, it's not so difficult, it's hard to apply some of these rules, and they're trying to apply other people's rules and they don't work, and then they give up. You've been there, or?
Yeah, that was my almost the exact time horizon that I always thought I wanted to be a trader. Due to work, I couldn't. So when I came in full force, and with all the lack of skills, like a lack of a skill set and lack of proper horizon, getting the first few properly good trades in, and all of a sudden you're being burned and you don't know how to deal with it. And so my sort of end game was kind of like, I'm not so sure this is exactly what I want to do. It doesn't fit my personality as well as what I'm kind of more of a natural entrepreneur or something like that. That's kind of something where I feel like I can fully sort of develop from who I am. But if I would start again today, having done this, which is kind of like a masterclass for me, and having understood how many different approaches there are and how rigorous you have to be regardless of the approach, it would be a completely different experience.
Well, you've just described the 5th stage that's not included in that video we just saw, called by this anonymous person. And if you're out there, get in contact, because there's some really interesting stuff in here. Called the eureka moment, when you realize that what you're doing is wrong and it's not working out. And most of the problems, the issues, surround risk management.
Yeah.
And that you may have or may not have a good system, but most of it is because you yourself are not applying, sticking to rules. Your system doesn't necessarily work off the right risk return parameters or the right probabilities or whatever. And then you start to, if you're going to go through that, or let's say you were to come back into trading, then you learn about proper money management, risk return, and leverage, and the probabilities, etc. And then you start applying a system. And that's when you get into the conscious competence, knowing that you've got a system that's going to work sometimes, not all the time. You're going to lose money, but you're comfortable with that because you know your system is going to work.
But can I play you a video in regards to this that I showed you before, the Donald Rumsfeld video? I think it fits fairly well here. In terms of understanding how markets move and your part in it.
Yeah, far away, yeah. Go on.
This is a 30-second clip, which I personally find deeply impressive, and it was utterly ridiculed at the time. He's talking about how to deal with information flows from a government.
There are reports that there is no evidence of a direct link between Baghdad and some of these terrorist organizations.
There are known knowns. There are things we know we know. We also know there are known unknowns. That is to say, we know there are some things we do not know. But there are also unknown unknowns. The ones we don't know, we don't know.
Excuse me, but is this an unknown unknown?
I'm not.
Several unknowns, and I'm just wondering if this is an unknown.
I'm not going to say which it is.
Mr. Secretary,
I'm right here. I'm right here.
Hats off in two ways. One is he's clearly a clever guy. He's also very articulate to hold that in his head and and not make any get it wrong as he delivered it. But actually, well, he's a very contentious figure in history, isn't he, Donald Rumsfeld?
Politically, yes, very.
There's a great way. One of my favorite quotes of all time. He delivered. Someone asked him, and apologies to any people of this nation out there, but he was once asked what it'd be like to go to war without France, and he said going to war without France would be like going deer hunting without an accordion. And I just thought that was
that's brilliant.
Which is one of the best put downs of all time in history. But anyway, that's beside the point. I mean, because that alludes to a contentious person in a contentious time. So I don't really want to go there or dwell too much on that.
But in terms of the pure sort of intellectual weight of that speech, that 30-second speech, there is something. There is a lifetime of experience behind that little quote.
It's learning about awareness, isn't it? I mean, it's something, and it's very apposite. It's very appropriate because how I describe what I've done. I haven't been aware of learning over time, and you look back and you realize that you have done it. It's only in the last 5 years or so that I've actually been very aware of what I'm learning and how and why, and the rest has been incremental. And that's why I'm saying people these days are so fortunate. There are a lot of people out there, a lot of texts, videos, everything, courses that actually do help you learn and do it in a structured way to a point, to the fifth and final stage. Is, Donald Rumsfeld was talking about the unknown and the known unknowns, when in fact you get to the unknown knowns, which it kind of sounds self-contradictory, but it's a point where you start doing things without thinking about it. And a lot of the things I do, I've talked about this before, how I start a day, I don't actually think about how I do it. A lot of things are so unconscious now, I just do because experience has taught me to do that. And necessity. I think you learn so many things through necessity as a trader. That's how you become a successful trader, is because you learn through bitter experience and then you start implementing them, the conscious awareness of what you're doing, and then you start doing it because trading is actually quite monotonous. It's a process. Do it over and over again. It becomes so natural, so ingrained that you don't even think about it. And that's the ideal state, is where you come, I was going to say a money-making machine, but you become a trader in the sense of you do things, you trade, without having to think too much about what you do structurally. Risk management is all part and parcel of the stages of success, if you like. There's also I want to throw this out slightly as almost an aside, because there's so many, and I want to take this on to the next phase. There's the 6 phases of, is it 6 stages becoming a trader? Bovada. There's another list there as well. Have you got that there? The mystification stage, the hotbot stage, the cynical skepticism stage, the squiggle trader stage, the inwardly bound stage, and finally mastery.
Can I ask you a question?
Yeah.
Which of these stages involve buying newsletters and listening to like these things? Is that like, do you think that's a positive thing, or do you think that's a negative?
Well, I've got a vested interest. I have a service that helps people in terms of direction. It's also got a trading analysis academy, probably a better way of describing it. So, what am I going to say to that?
No, I don't know. I'm not saying it as a charge statement.
No, you don't need to. But look, I mean, what I've talked before about, if you want to be a good trader, and you want to be you want to keep your account and keep your capital while you're learning, then you would really want to look for shortcuts. And then the question becomes, what shortcuts do you want to take, and how should you take them? And you can be advised, again, in the shortcuts, listening to programs like this, listening to brokers who, provide free services, in getting some ideas of them as to how you and where you should do it. The problem is because it's free, they don't necessarily dedicate the full amount of resources that they could, or you would want them to help you do that, to take to take your shortcut to the fullest extent.
But it's also I think I told you that I got a question from I think it's a viewer that asked me about technical analysis, like, where do I find information about this? And my first question was, why is that? Why do you want that? Because he clearly was fairly a novice. And I think that most people, they enter this world through, let's say, an article. They read about some kid that made $1 million. That could be the first trigger. Wait, you can do that? Maybe I should do that. And then you discover a few things. You find people like, I don't know, Hedge. That's like a famous Twitter account. And you find, so you move into this. And it's just interesting to know, like, it's almost like a rite of passage you move through in trading. And I think
you do, and it doesn't stop. There's actually, which brings me kind of nicely on to, in fact, you talked about technical analysis, and someone like Paul Tudor-Jones, who I would describe as my mentor, though obviously I wasn't trading with him or anything like that, but someone who thinks very similar way. I flatter myself if I dared liken myself to him, but he has a very similar approach in many respects. And in fact, he said, you talk about technical analysis, and there's a great quote. I will quote. It's not, I haven't got a plaque for it because I wasn't aware you were going to mention this guy talking about technical analysis, or you talking about technical analysis. Yeah, people were drawn in by greed. They're drawn in by the possibility of making money quickly. The old pioneering spirit. They don't want to necessarily go and develop a business for a year, 2, 3, 4, 5 years, or whatever, and maybe not make it. When trading, you can make it tomorrow if you get lucky. It doesn't have that. Trading definitely has that appeal. And Paul Tudor-Jones actually described something like some of the nuts and bolts you need to learn. And he's saying that these days there are many more deep intellectuals in the business, and trading is a business, believe me. And that, coupled with the explosion of information on the internet, creates an illusion that there's an explanation for everything. Yeah, I mean that's quite self-appealing, or appealing in itself, that there are answers out there that can help me make my million tomorrow, and there's an explanation for everything. And the primary task is simply to find the explanation. So it's got to be out there. As a result, technical analysis is at the bottom of the study list for many of the younger generation, particularly since the skill often requires them to close their eyes and trust price action. The pain of gain is just too overwhelming to bear. I mean, I think it's just it's very articulate, very eloquent, but it speaks volumes about how you have to go step by step by step, and be aware that you kind of need with the benefit of information, you can actually structure your steps in advance before you reach them. Rather than someone like me has to stumbled over many steps accidentally. We're so fortunate now that there are services, and there are people charging you $3,000 to come and learn to trade, or $5,000 or $10,000, whatever. And you know, there are some really good services out there, and I wouldn't.
Do you think some of these 5,000 services are worth it? Can you measure it in P&L?
No, it's very. Yeah, no brainer, no doubt whatsoever. If I tell you, that you show me how you trade, and I'm saying, well, it's quite obvious. Your risk return is wrong on every single trade you are doing. Your risk return is wrong. You go away. I mean, it depends on the size you're dealing, but I could have just saved you 20, 30, 40, 50, 100,000.
Yeah.
Yeah. There are people out there managing hedge funds who don't employ some of the basic soundest techniques in risk management. Yeah. Some do some very, very, very clever things, but there's some who don't, who could go to a service. You know, they could pay $3,000, $5,000, go to a service and realize and reinvent themselves. The very fact, as you probably gathered, the very fact that one addresses what one does, you know, sound like the Queen now, the very fact I ask myself, what am I doing? How am I doing it? Is a very, very important approach. It's self-awareness, you know, and that's where the five stages come. You go through the awareness, the extent to which you're self-aware, to the extent that you start to do things, the right things, in an unconscious vein. And that takes you on to an interesting stage. Is the stage I'm at, when you don't question things because I do them without thinking. And that's a dangerous stage, because, you know, if you take it to a level of detail where you talk about markets, or markets are changing, or they're moving in steps. Some markets may have moved on to the next phase and be like gold is no longer a trending market, but I'm trading it like a trend follower. I'm going to get buried as each time it comes back, I get stopped out. If I'm not aware of what I do, even though some things I do unconsciously, if I'm not aware, I just put them aside, then I kind of come unstuck. So I need to be flexible. I need to question. I don't need to, every time I do something, every time I look at a trade setup and say, Ed, it needs to be 2-to-1 at least, no worse than 2-to-1 reward to risk. I don't need to do that. But if I need to say to myself, just step back, why am I trading? Why am I running after this trending market that's not really trending?
Yeah.
Why am I stopping out, and I'm not, on the euro every time it goes to new highs? Why? And then you start learning, why am I actually eating the stops on the euro dollar? Anywhere it goes, stopping out. And as a short-term trader, it just is going for the stops. The same with euro sterling. For the last 9 months, where the obvious levels to break, takes them out, stops them. Once you start realizing, being aware of some of the things, you start factoring that in. So when what I do, let's say I'm fading when I sold 137.65 on the euro, as it broke to new highs, I was eating the stops. I then say to myself, I need a 2-to-1 risk return.
Yeah.
And so I need to get I apply my methodology, but I'm also aware that the market is changing. You sent me a message about Michelle coming on, because it would.
Yeah, it would. I think it would fit quite well in this conversation here, because.
I do. Well, let me just. There's some people will be aware of market profile volumes. You heard of that, Peter Stoudemire?
Not immediately.
I don't profess to be an expert in market profiling, but it's about the volumes and where the volumes at certain levels in a market or in a trend or whatever, and it gives you good information. I think it's a brilliant approach. I think it forms part of the same category. Do you want to put up a quote from him?
Is it Dow theory, or are we jumping a little bit?
No, you got a quote. Trading is human.
Sorry, trading is being young.
Yeah, which I kind of think is ironic in a way. Let me talk a bit. Market profiling is, I think, very similar to fractal analysis, and I hadn't got into it enough. I mean, there's a good example of how you should always be learning and always be aware. It's tapping into and trying to understand a market and how prices really move and why, beyond what we know already. And I think to understand and recognize that the volumes and why people do buying and selling at certain prices, factoring that into your analysis it's all part of sentiment analysis in some ways, but it's very important, and I think it's very underexplored. And so what the work he's done in that area, is really good. Do you not have?
Yeah, I have it here. It got corrupted and transfer here. So one second. It's a little bit of last minute editing here. There we go.
Yeah, trading is being young, imperfectly human. I just love this quote. It's so real and human, and it's actually one reason I started doing this with Use Ferry is there's a lot of gloss out there. It's a very rich, fat industry. A lot of people want to join it, and it's very glossy, and the gloss sells and traps people and attracts people in the wrong places. Exactly. It's not real enough, and I think. Well, one thing about BIGtv, I think, is got the opportunity to be very real. And I think what he's alluding to here is reality. Trading is being young, enthusiastic, imperfect. You're not going to get everything right and human. That's definitely recognizing the mistakes. And it's not old, exacting, and scientific, which kind of goes against the grain because it recognizes that you need a commitment to be organized and disciplined. You need to have to make a commitment to kind of change yourself from being a young and perfect human, if you like, to being scientific, being exacting, to be committed, to be what essentially you are as a trader, is an information processor. You know, once you realize that, trading becomes so much easier, so much easier. It's when you take it to heart. You know, I've as a trader, I've cried many times, not recently or in recent years, but you know, when you get hurt by losses, you then want to walk away. You don't want to do it. Well, someone like me who just loves trading, I'm not going to do that. So I need to find methods and approaches that are going to help me do that, and that's how you get to that position through those 5 stages of competence to being a professional trader who does things unconsciously, and partly because it actually protects you. It helps you. You know, protect yourself from the losses, inevitable losses, and the pains that you'll suffer. There's another Stoudemire quote. Can we move on to that?
Sure can.
Actually, don't. Before you do, let me just say, I'm sorry. There's a great Paul Tudor Jones quote as well, which kind of ties in with what I was just saying. It's the normal. If you get beaten up so many times, yeah, you can do one of several things. And as a trader, any successful, there's a great quote actually I quoted on the weekend about winners actually lose more than losers, but the reason they're still here is because they keep winning and they win in bigger amounts. And so successful traders know how to lose money, but because of that, they become far more aware of risk. And as Paul Tudor Jones says, the normal progression for most traders he's seen is that as they get older, or in other words, more experienced, something happens. They get more conservative. Yeah? They want to take less risk. There's a picture of him with his, I believe it's his wife, and things like that, natural things in life. When you're a youngster and you're out there and you've got no ties and you can risk things and it doesn't really matter, you can always start again. But when you've got a family, I've got 5 kids, private education, etc., that starts adding overhead. You can't afford, you can't. I've got a massive overhead, and I need to can't go for the big one and risk everything because I can't afford to lose. So again, the disclaimer: don't ever risk anything that you can't afford to lose. No. So that naturally is a natural. There's no verb to conservative. You actually makes you become more conservative, and you need to recognize that. And that, again, when you do things, you build things into a process that makes you do things unconsciously, a good risk management system, then I take risks that I'm probably not quite of that conservative mold, but arguably people would, when they've got a good, strong system, they can take greater risks than they would be naturally inclined to do it once they get older and more experienced, because a risk management system allows them to do that. Do you follow my point?
I
A
think you're right.
youngster,
I think
anyone
I'm
starting out
kind of a case
enthusiastic, it's
study.
funny because what it's saying is not just being risking out there, not worried about how you risk things and go ahead and you know punt away, and then it doesn't matter. There's always tomorrow. I can always start again. Can you? You know, it's not. There's that mentality, but then there's the flip side that you can't afford, and then you get too nervous to take a trade. You know, and you say, well, which is often the best trades. Yeah, the best trade, hardest trades often turn into the best trades. Doesn't mean that every hard trade will be a great trade, but often, you know, eating stops is quite hard because everyone else around you is stopping out, saying it's going the other way, and you're saying, "I'm going to fade this." That's quite hard. But if your risk management system allows you to do that, your edge, your approach, then you've got to, you know, you can do that almost unconsciously. It doesn't matter.
But when you talk about risk like this, we're moving into the territory of also of hedge funds. Maybe we should bring on Michelle now. I know she's a little pressed for time, so do you think this is a good time to bring her on for?
Yeah, no, definitely do. And just yeah, no, as you bring Michelle on, put the other Stoudemire quote up because I think that's a nice it's a nice tie-in with Michelle as well.
Yeah. So we're bringing in Michelle to the conversation now. I don't know if you can hear me. Here's the quote up. Michelle?
Yeah, I'm here.
Hey.
Can you hear me?
Yes, we can hear you fine.
Okay.
Yeah, I mean, Michelle has been. Hi, Michelle. How are you?
Hi, Ed. How are you? I'm fine.
I'm very good, thanks. Just finishing on what I was talking about Peter Stoudemire, that good traders offer no excuses. They make no complaints because they've made all the excuses they previously, and they've complained enough previously. They're just willing to get on with it. The vagaries of trading, the vagaries of life. And I guess that's some of the qualities of.
I mean, what do you think, like, because I think a lot about sort of barriers to entry in terms of becoming a hedge fund manager. What do you think about the barriers to entry for becoming a good trader?
A good trader or trader, the barriers to entry, that's a really interesting, good question. The barriers of entry for a trader are too small, too low. Too many people can come in and not know what they're doing at all. I mean, you're talking, I remember when I started, because obviously I'm being a professional in the professional market, studying in banks, et cetera, and all my clients being investment banks and the like in hedge funds, and then going into retail market, someone said, Ed, you don't realize some of these people, the amounts some of these people are trading with are so small. You know, they're risking 50 quid on a trade or whatever. The fact they can do that, people can do that, to me suggests that there are no barriers to entry, really. There are very few barriers to entry for a trader. To become a good trader, then there are a huge number of. There's a great list. That in fact I tweeted, in fact may tweet later today, of 38 steps to becoming a trader, a good trader.
Wow,
You know, that's a huge number of steps, and I'm sure. You know, once you become a good trader, then you may look to, if you trade your own money, you may look to trade. Yeah, that's it. It's really, actually very good and worth reading. But I wanted to, let's talk about becoming a hedge fund manager, because once you become a successful trader, you remember that a lot of trading is aspiration. Once you've been successful, you are successful trading. And what is your next step as a trader? Do you want to manage other people's funds? And then do you want to set up a hedge fund? And everyone says, I want to set up a hedge fund. Then it's not so easy, is it?
Exactly. And I mean, the bad news is that the barriers to entry to starting a hedge fund have gone up in recent years. It's unlike the barriers to becoming a trader. And I mean, I don't really like to be the bearer of bad tidings and to be a negative person, but the reality is that about 80% of hedge funds fail in the first 2 years. And that's not because they have bad performance or because they're bad traders or even because they exercise bad risk management or blow up. It's simply because they just don't raise enough money or outside capital to be viable.
I mean, their overhead is so large.
How much do you need to start to run a fund?
Well, it depends a lot sort of on the strategy. I mean, if you're trying to sort of run a quant fund, that's very IT intensive, and the startup costs are going to be a bit higher. But I mean, the minimum really is 50 million, even 100 million dollars in AUM, and that'll maybe cover your sort of infrastructure costs, your setup for about 1 year.
Wow.
AUM being assets under management.
Yes, exactly, exactly. And that's just because, you know, investors today, they expect hedge funds to have institutional type infrastructures. They want to see sort of separation of duties. You have high overheads, you have compliance costs, you have regulatory costs, legal costs. And yeah, so it's quite difficult, and yeah, the reality is that most startup hedge funds are going to fail, not because of performance, but because they're just unable to raise the minimum level of assets under management.
It's interesting because I think the stat for restaurants is the same, isn't it? 80% the first year
Yeah,
fail
probably.
or whatever. But that's not.
No,
that's
I mean,
because
yeah, and this is why, you know, again, your chances of success in terms of starting a hedge fund, they're going to go up so much more if you're coming out of an existing prop desk, hedge fund, or even from sort of a brand name bank. You know, in fact, well, probably the optimal situation is to be like a superstar trader coming out of an existing hedge fund, and where the hedge fund then goes on to sort of seed the spin out or the startup.
Siege, the spin out.
Sorry?
Did you say the hedge funds?
Yeah,
sieges.
Where the hedge fund seeds. So
I see. Sorry,
this is the case of a successful trader. He's like working in a big hedge fund, and he has, you know, a discussion with the PMs, the partners of the fund where he is, and they agree to let him sort of set up a carve out or a spin out from the existing fund, basically just to take his trading sort of book and use it as the basis for a separate fund.
Yeah.
And then they will sort of go on to sort of seed the fund, usually with some startup capital. There the requirements might be lower, maybe in the order of 25 to 50 million. But more importantly, they support the startup with all of the back office infrastructure, the compliance, and the legal.
That's interesting because the legal costs now are huge because of all the regulatory changes and all the regulatory demands. But it's interesting, we've seen, especially in Scandinavia, we've seen a lot of ex-mutual fund guys go into hedge funds because they hear about the 2 and 20. That's 2% management fee and 20% performance fee. But then so far I've yet to see a single success out of that. Do you think you have to do you have to come out of a hedge fund to run a hedge fund? Because that seems kind of like...
well, that taps in. If anyone, you know, the traders who be listening to the program and saying, well, okay, that's all very well, but I don't work for a hedge fund. I don't work for Goldman Sachs. I'm not a superstar trader in the bank. How do I? How, you know,
well,
people listening there,
like
how do they become
platforms
hedge fund traders?
like Broomer in Sweden that will identify good traders, and if they pass all of the tests, we'll then sort of seed them with some money. But the trade-off is that Broomer owns the business. So usually there's some kind of agreement about sort of fee sharing, and some of the Broomer seeded funds have gone on to be very, very successful. So there are ways. I'm just saying sort of that the odds are stacked against you, and that's something that people need to like clearly think about.
But success breeds success, is what you're saying.
Sure. And, you know, when you start a hedge fund, it's also like starting a business. And, you know, you're going to spend 20 to 30% of your time on business issues that have nothing to do with trading, hiring people, you know, managing your IT, spending time with lawyers, doing your documentation. There's a lot of sort of work that goes on in the background.
Which actually sometimes is not a bad thing, because too many traders, in my experience, they're stuck at the desk too often and don't get out and don't do other things and don't appreciate some of the support work that's being done for them by other people. If they do it themselves,
Yeah.
then often, in fact, they can help their own, their own setup. So if you were, let's say you were a trader and who's got a good track record, how would they go about turning themselves into a hedge fund?
Would they want
to go to one of these shops and say, look, I've got a track record, and they say, okay, that's cool. How about, you talking and developing a relationship with them in the hope of getting some money under management? Is that the best way to do it? Or
they need to ask themselves some very sort of hard questions about how they're going to raise money.
okay,
I mean,
what
raising
questions should
money
they
is
ask
key.
them?
It's and I mean, it should not be sort of underestimated how long this can take. And again, they have to also sort of look at their investment strategy and sort of what they're sort of proposing. Investors are looking sort of for three things in terms of the investment strategy. First of all, sort of, does the trader have a specific edge? Second, is the investment process repeatable? Something sort of that can work in a variety of market situations, that can be replicated over and over again. And third, is it something that's easily understandable? And a lot of traders, they have a good sort of performance, a good track record. They've had good performance in the past, but they're not able to clearly sort of articulate sort of these 3 points. So that's also sort of something that needs to be thought about.
It's interesting you say that. I've known so many people fitted into the category you described, superstar traders, whatever, coming from their own hedge fund, breaking off, people, just good traders who got into a new environment, who find it very difficult to perform, not just because they've got to do all their other stuff, but they have to change the way they do things, the way they trade. And once you start doing that, your dynamic changes, your whole, the reasons why you've been successful change. And that's really
and
hard.
I mean, there are a whole host of reasons why hedge funds fail that have nothing to do with performance. I mean, there's also, the issue of interpersonal issues. So you have 2, 3, 4, traders. They're maybe sort of good friends. Everything is nice and rosy, and they think, oh, hey, it would be a great idea to sort of set up a hedge fund together. But it's quite a different thing to be, friends with someone, to actually sort of setting up a business with them. And quite a lot of hedge funds fail just because of interpersonal issues between the founders and disagreements.
That applies not just to hedge funds, but to any type of business. I mean, it's an old cliche that you shouldn't go into business with your friends, because there's a risk, partly, that they won't stay your friends if things go bad, but also it's a different dynamic. Again, it's trying to duplicate what's successful and making sure it's sustainable, I guess, is what you're saying.
Sure, and I mean, that's why one of the questions that institutional investors will ask when they're sort of evaluating a new hedge fund, they'll ask the principals or the partners just to describe how long they've been working together, how they know each other, because this is really important, especially sort of when and if problems come up.
Do you think that the hedge funds because one of my pet peeves is that hedge funds have a very unfair reputation, that they it's this like greed game and everyone is very rich because some people are clearly very rich. The best paid people in the world are hedge fund managers. I think George Soros made over $1 billion one year. And it seems that there's a number of issues. First, there's quite few hedge funds. There's anywhere between 7,000 and 13,000, depending on who you ask and how you define it. And you seemed quite down on new funds, because most of these funds that are established, that are well known, were started in the early 90s. So are you? Is it almost impossible to start now, or is it?
I'm not down on new funds. Actually, sort of new funds. There are academic studies that show that new funds consistently sort of outperform older ones. I'm not down on them at all. I just, you know, the reality is that 80% of them are going to fail or close down for one reason or another during the first 2 years. So people should think like long and hard sort of before they take the step.
Yeah.
That's all. But I'm not down on them at all. I mean, we've invested in startup hedge funds before, but you know, again, we've never invested in a sort of startup hedge fund that was like a pure sort of standalone sort of entity. It's always been a startup that was part of a larger organization where we knew that there was going to be enough backbone in terms of sort of the infrastructure supporting the traders.
Could I ask you, what about the shoe on the other foot, if you like, the other side, as if someone who wanted to invest in a hedge fund, then, you know, is it like the old story about with mutual funds, you just find the top 3 for the last year and you invest in them, and history shows that on average you'll do better. Does it work that way?
Oh, no. I mean, today, I mean, if you look at institutional clients, pension funds, endowments, I mean, these are the biggest investors in hedge funds today. And they are very, very slow in terms of making an investment decision. I mean, they might be looking at you for a year before they allocate any kind of serious capital. You know, these are very bureaucratic organizations. You know, the number of hoops that you're going to have to sort of go through to get on their is incredible.
Yeah, and one thing you're mentioning is the bureaucratic nature of it. And I know me and Ed has touched upon a little bit on the George Soros of the 92 at that time, and you had this like this reputation for hedge fund of being these like kind of like wild prop trader kind of. They have these very specific.
That's because the investors were different.
Yeah, that's what I mean. And investors now are so risk conscious, and you have only You have only these very risk averse type of investors. So that kind of hedge fund hardly doesn't exist anymore.
That's true. That's you know, that's a big issue. I mean, I think hedge funds are so concerned with managing their volatility and the risk that far more concerned sort of than was the case 10, 15 years ago.
So would you think if George Soros was starting now, would he be setting up a hedge fund, or would he be a proprietor? Would he be someone like me as or private money, or would it be you know, would he be a private trader? I mean, what would he be doing now? Do you think?
That's a very good question. I mean, I'm not sure.
Maybe we should have him on and find out.
Oh yeah, I think I can get him on actually. I have a 1% chance. It's better than 0. But you sent me an article, Ed. Do you want me to pull it up on the screen?
Yeah, do. Well, you did, about George Soros wanting to invest in the finance sector. It's interesting. I own, some people will be aware, if they follow me on Twitter, will know that I've been heavily into banks in the last 3 years, buying what, you know, like the Citibanks and Lloyd's and buying up, you know, the propped up government style banks, just because the value, you know. I mean, it goes back to, if you buy enough banks, then okay, if one fails, and I'm talking about quite serious major banks as well, if one fails, then at least the amount I make on multiples are going to cover the risk or the loss and elsewhere. And what is interesting is why George Soros would be buying banks now, or if that's a real story. I mean, this is, again, it touches on what we talked about analysis paralysis, when people are supposed to be doing things, and do you go with it? Do you understand it? Do you investigate it anymore? But if George Soros is buying banks now, I mean, what does that say? I mean, to me, I'm still holding some of these stocks. So, Michelle, what do you think? Is
I
the
don't know. I'm
banking
highly
sector still good
skeptical
value?
of any journalist or newspaper article which claims to know what sort of George Soros is doing or not doing.
I'm supposing
sorry.
this is based off of the 13F. It's a Der Spiegel article that on Sunday, where he said, "I believe in the euro. Therefore,
Yeah.
my investment team is looking forward to make a lot of money soon in Europe by, for example, pumping money." That's actually a quote. "Pumping money
Yes.
into banks which urgently need capital."
Yeah.
He added, noting the eurozone needs this kind of private investment
Well,
right now.
Maybe he's buying Greek banks.
Yeah.
I don't know.
Yeah, I mean, well, maybe he should be buying Greece. I mean, he's of that size, isn't he? I mean, what was the, was it? I can't remember. What's the someone like pointed out that the whole of the Greek stock market has a valuation less than one or two than quite a few U.S. corporations. I mean, it's frighteningly small. It is really of a small size.
The
George
total
Soros
market
could
cap?
probably buy entire Greece. No? I mean, what's the size? Do you know the capitalization of the
I don't
Greek
know the
stock
market cap of,
I'm checking.
Greece off the top of my head.
Oh, I'm disappointed, Michelle. I thought you knew all these facts. But yeah, I think Greece represents great value. I mean, again, disclaimers. But you know, it's a little bit esoteric and dangerous for me to do anything of any size. But I'd be interested in dabbling. But I'm just interested to see if
The Greek banks have had a tremendous run, sort of last year and even this year. I think it's Alpha Bank, which is up like 24% this year, and
I have the number.
Nothing. But that's not. I mean, 24% is big. Don't get me wrong. But we're talking its potential. This is maybe where George Soros, if he is investing, is coming from, because they've been so.
I mean, I've spoken with hedge funds that think that the Greek banks could easily sort of double.
And the rest,
next,
I mean,
12
how much
months.
they've fallen by. I mean, how much would the Greek banks, if they went back to their previous crisis level, we're talking multiples of what? Five, six?
Yeah.
So I have some numbers here. Facebook.
But you can say the same about.
No, I have some
Italy.
numbers on Greece here
Okay.
before we. So the market cap of Facebook is 174 billion. The market cap of the total Greek stock market, at least by some IMF indicators I have here, says 151 billion. So it's about 20 billion less than Facebook, which is astounding.
And how much cash does Apple have?
Apple has about 150 billion. Seriously. And if we would go back to pre-2008 or pre-2009, I think, the Greek stock market was approximately almost 6 times larger than it is now in terms of percentage of GDP, and GDP has dropped at the same time. So.
Yeah.
So people sweating over where the euro is going today for the next 20, 30 pips, and you could be talking dimensional trades. And it's kind of, that's when it gets interesting, and why it's, I mean, interesting following people like Michelle and certainly structured research, because there's some really interesting stuff out there in terms of real big plays. You can listen to me about.
I mean, there are a lot of event-driven funds and distressed players that have taken big positions in the Greek banks. So if you look at the composition of the share ownership, it's like completely changed compared to what it was pre-crisis.
Could that be self-fulfilling? In other words, because these investors are going to.
I think that's actually a good thing, because when the distressed players, when the event-driven players come in, I mean, they're not sort of looking to flip these positions in the short term. I mean, they're clearly there sort of for the workout.
And therefore they're more likely to put pressure on them being managed well, and in some ways where the distressed players are coming in, the risk is much less.
Definitely.
And is so what credence would you give to the George Soros story then?
Oh, no comment.
Who wrote that? I have to see.
All right, let's put it another way then.
I mean, I just
Could
hate
George
articles
Soros
like
be
that,
interested
you
in?
know?
Could George Soros be interested in buying banks right now at these levels? Theoretically,
Sure.
do you
I
think
mean,
it makes sense? It could be made sense to.
Sure. I mean, this is sure he could be interested, like anybody else who's looking for undervalued assets. Yeah, of course.
Okay. You're not
But
going to be.
I mean, buying Greek debt has been a big play in the past year. I'm looking back in. You mentioned the structured research, Ed. There was, which is sort of a service run by us. It's sort of loosely part of BIGtv, and we had a bunch of stuff on the best performing hedge funds of last year. And one of the interesting funds is a special purpose fund, which is, I believe it's Algeberis. Is that the one?
No, Dromius.
Dromius, yeah. I'm just looking back to get. It's a fund that is set up only to invest in Greek debt, and I'm pretty sure it's up 100% last year. Am I right in those numbers?
Yeah. Yeah, I think it's 90% sort of since inception, sort of over the past 18 months, something like that.
Yeah.
But it's been, you know, a phenomenal call. And
So
if anybody has access to the FT, to the archives, the FT is like has interviewed these fund managers a couple of times over the past few months.
Okay, well let's bring this this back, because I think Michelle's got to go. Is that right?
Yeah.
Let's bring it back full square, because what we're talking about, I think, is the stages from being, you know, I mentioned a guy who comes in and who's going to risk 50 quid on a cable position, or FTSE or S&Ps or whatever. And, you know, there's a learning process through many steps. I think there's going to be a couple of tweets we'll send out, one of which is at 38 steps to being a successful trader. I mean, and it's worth reading, because most of those steps are really valid. And some of the things you're not aware of, I'm not aware that I do. And as you become through those stages of competence, what's happening is then you realize, you know, you're doing things wrong, and then people like Sverre stop and maybe comes back into trading once you worked out what maybe you should do better. But at each point, your awareness of what you do and how you're doing it is growing to a point. Then some of the simpler things that you need to do, the basics, you actually start to do unconsciously. You don't think about it, but you're always still aware. And in fact, what you're saying is, from a trader, being a trader to a hedge fund, you jumping another level of awareness in terms of running a business, of running a risk business, and how you quantify the risk, how you present your returns compared to your risk, of how long you need to do that and to who you need to do it, is on another level as well. So there's a progression, all these steps, from being the guy with 50 quid in his pocket, having a punt on the DAX, to someone who's the George Soroses of this world, you know, 150 billion to play around with and buy the whole of Greece. There's a massive learning curve in terms of the steps. But if you keep going, it's doable. Isn't that how much did George Soros start with? Didn't he start with 50 quid in his pocket?
I think it's self-made, isn't it?
Probably something like that.
That's a good question. I never.
Yeah.
He's probably still got it.
You like George Soros. Here's a quiz. What's his real name?
I know. It's stupid. I did know that like 3 days ago, and I've forgotten. That's not a good question.
It's I don't know how to pronounce this. Georgi Schwartz.
Yeah.
Anyway,
Schwartz.
he moved to London. Well, he started quantum funds with Jim Rogers in '69, so he's been around for a while. And he grew up in Hungary, moved to London in '53, New York '56. They kind of skip all those steps between. Stupid Wikipedia.
I mean, there's actually a great quote which I would challenge you to find, because we've used it before. I mean, in fact, I think we used it last show or the show before, Jesse Livermore, about trading as a business. Anyone, if you recognize anyone, I think it goes something along these lines, anyone with any intelligence who's willing to put in a lot of hard work and then recognizes that trading is a business, you say a hedge fund, managing a hedge fund is a business, will do well. And then if you know that, if you're willing to put in all the hard work and to follow the steps, recognize there are steps, and then they will be different, but follow the steps and pursue, keep persisting, and you're rigorous about it, then as long as you're hungry, then you'll succeed, I think. And that's the beauty of the great pioneering industry that is trading, that is hedge funds as well. I think it's arguably the most accessible, the most, or possibly most demanding. I tweeted something on the weekend about being the most demanding profession there is, but it's also the most exciting and arguably the most rewarding as well. So perseverance.
If you continue a little bit more, I can pull up the quote.
Yeah, go on, go. See, I compare, see how my memory is.
No, but it's good, it's perfect. It's, I believe that anyone who is intelligent, conscientious, and willing to put in the necessary time can be successful on Wall Street, as long as they realize the market is a business like any other business. They have a good chance to prosper.
Yeah, that's very good.
No, that's Jesse Livermore as a mantra for anyone running their 50 quid in their pocket footsie punting to George Soros. People like that are managing significant businesses and risk. And good luck.
Yeah. There you go. Better late than never. So, but I think that's a nice wrap up to this show here, and I want to thank Michelle and Ed for both taking time
thank you.
to come along, and we're going to continue on the stream. So the idea is to do a pre-show, a show, and just continue on a little bit more, and then we can just talk a little bit more. And but this ends the recording. It was a great talk, and we covered a gambit from starting with the 50 quid up until the guy who's trying to raise 50 million. So thanks both of you for coming along.
Thank you.
Welcome. No, cheers. Good one.
Cheers.